We have Vidit Atre, CMD and CEO at Meesho. We also have Dhiresh Bansal, Chief Financial Officer at Meesho. Gentlemen, great to have both of you here. Thanks very much for joining us. Prashant this side. Vidit, before we get into asking you about the path to profitability, and I think that's what's relevant for our investors, but I just want to tackle one issue which Bloomberg put out a story yesterday. Essentially, and it's a good problem to have. Too many people want your stock in the anchor book. Not everybody could grab or get their hands on what they wanted. And apparently, a bunch of funds like Capital Group, Aberdeen, etc., stayed away. I know it's not your fault. I mean, I think it's people who are managing the issue and bankers, etc. But just a quick. I don't know if you have any thoughts at all with it.
Yeah. First of all, thanks, Prashant, for having us here. So I think, as you said, there was a lot of demand for our stock, and not just in India, but outside of India as well. I think people have seen very similar stories in many other geographies in China, Southeast Asia, Latin America. So there's a lot of excitement about Meesho, I think, everywhere. And as you said, like, not everyone could kind of get the kind of allocation they wanted. And most of this was kind of handled by the bankers. So I don't have much to say over that point. I would also say that, like, our goal is to have the right long-term shareholders. So some of them who could not kind of come now, we'll keep engaging with these investors even in the future and make sure at the right time they come into the company and basically capture value over the long run.
Okay, fair enough. And we'll try and get the bankers on as well. It's an important issue away from, of course, the Meesho IPO, which we are focused on now. With it, as Mangalam said, I mean, key to understand, of course, now is how you're thinking about being sort of consistently profitable and path to profitability. Just give us the outline of your thinking there. I know that we won't be able to push you to get some numbers out. Maybe we'll do that on the day of the listing. But give us a sense of how you're thinking about this question.
Yeah, I think we've been very consistent about this. We, as a company, look at free cash flow as the right bottom line metric. Any company textbook definition of valuation is the net present value of all your future cash flows. And as a company, we've been the most capital efficient asset light company, right? Like, to kind of reach a lot of milestones in our business, we've actually spent the least amount of money as compared to many other e-commerce companies in India. And we take pride in that. We continue to kind of optimize for free cash flow. If you look at the last 2 financial years, we have been positive on free cash flow. For the last financial year, 25, we generated almost 1,000 crores of cash. And even forward, I think we will continue to kind of keep looking at that while doing capital allocation within the company. I think as the business keeps growing, all the other accounting metrics around bottom line will obviously keep getting better. But we take a very long-term view to this problem. If the business is generating cash consistently, getting bigger and bigger, there's no chance that the shareholders get diluted again. We create more value for the investors in the long run. So we believe that's the right way to think about this.
No, absolutely. No taking away from that at all with it. Free cash flow is always a very promising sign for public market investors. But we want to understand the way you're thinking about the path to profitability a little more. Maybe Dhiresh can weigh in on this as well. Dhiresh, so out of the money that's coming into the company, a fair amount is going to be spent on building up your tech. It will be tech systems, it's tech talent as well. I think over 400 crores is going to be allocated towards these brilliant tech brains that you want to have on board or already have on board. And I think about 1,000 odd crores, 1,020 is going to marketing and brand building, but almost 1,400 crores is going into cloud infrastructure. So my question really is, for how long will you be in the build-out stage? And how much will the spends on tech be? Because tech is very, very intrinsic to the platform, time to delivery, the way the algorithms work, pricing and so on and so forth. So just give us some idea of how much spends on tech. And then therefore, what is the roadmap to profitability? Because while the free cash flow generation is there that Vidit spoke about, this cash is going to be constantly deployed into the business as well. So we need to just understand some of those details.
Sure. No, thank you for that question. And like you said, we are a technology platform. Most of our investments actually go into building out this technology. Actually, all of these investments that we make are expensed out in our P&L already. So it is not that we are capitalizing these expenses or they're going into the balance sheet. when you look at the net profitability metrics or EBITDA metrics, it captures the server cost that we spend, for instance, the people cost that we have on technology. All of those are captured in our P&L. So there is no capitalization of those expenses which is happening. If you look at the use of proceeds, we are raising these for the next 3 years. I think that is our estimate of what is the spend going to be in some of these headers for the next 3 years. And if you look at the historical trends, as we have grown consistently, some of our fixed cost base, such as our server infrastructure and other kind of fixed cost line items, including employee cost as well, have not grown at the same path or at the same pace as our overall top line growth has been. So operating leverage is a key metric that we would kind of keep tracking. Our fixed cost base, let's say historically, the server cost grew by only 4.5% when we grew at about 35%. And we'll keep maintaining that going forward as well.
So Dhiresh, this spend of about, I think 1390 crores is the exact spend on your cloud, etc. And about 400 odd crores is the spend on people, specifically the engineers who are enabling this kind of tech adoption. These are spends for how many years? I'm just trying to arrive at, if we look at the EBITDA level, the first half loss is about 700 crores right now. So you keep investing this money for what, 2-3 years? And then would it be fair to extrapolate that at least for the next 3 years, investors may still have to look at losses at an EBITDA level?
So the 700 crores, I think the number is slightly different. It's, I think, closer to 500 crores of...
Adjusted EBITDA is closer to 500 crores, correct?
Yes.
So we can talk adjusted EBITDA, fair enough.
That already includes these expenses of server cost, of the people cost that we have for this period. I think the estimate that we have, which is in part of the use of proceeds, is for the next 3 years. So the 1390 plus the 480 crores of technology-related expense that you see are part of already our adjusted EBITDA for the current period. And for the next 3 years, we are saying that this is the spend, not in addition to the current adjusted EBITDA, but as part of the adjusted EBITDA that we have, the trajectory that we forecast for the next 3 years.
Okay, all right. Hi, Vidit and Dhiresh, and good to have you all on the show. Welcome to the stock market, and hopefully we'll be chatting more often from here on. Well, let's focus on the growth prospect. All that adjustments and all, let's keep it aside. When your list, we'll push you a little bit more. But let's focus on growth. So tell us, what will be the key growth drivers going forward? Will it be led by monthly transacting users expansion? Or will it be led by high order frequency? If you could give us some clarity on that front. And if you look at your core business, order growth has been good, but the AOV has declined. And you're expanding in new categories as well. So what's the steady state AOV you're looking at? Will it decline further or will it hold around these levels?
So if you look at...
So I think, yeah, go on, Dhiresh.
Yeah. So I think if you look at the growth composition for the last 3 years, we have been consistently accelerating our NMV growth, which takes into account both our user growth as well as frequency growth in the business.
Okay.
If you look at our annual transacting user base, that increased from about 14% growth rate in FY24 to about 28% growth in FY25. And even in the first half of this year, as we crossed 23 crore annual transacting users, we grew even faster at about 35% growth year on year. Even in terms of frequency, our growth has been consistently there. The frequency used to be about 7.5 times 2 years ago, which is now inching closer to 10 times. Okay. So I think as we go deeper and deeper into India, we'll keep expanding the number of users who transact with us. And as our proposition becomes more affordable with the efficiencies that we are bringing in, the frequency of the users also continues to grow on the platform. And that will be the growth formula for the next few years to come. India is still very low when it comes to e-commerce adoption versus even other emerging markets. And a big way to kind of drive that adoption going forward is going to be affordability led, where we are kind of leading the path.
All right. And AOV, you want to give us an outlook of that?
Yeah, so I think AOV might decline. We don't have a sense of kind of gauging that right away, but it'll come with more and more frequency unlocks. So overall, from a GMV and an MV perspective, that is actually a beneficial thing to have, because that means that people are transacting in a lot many more price points than they were before.
Okay. Vidit, very small last question to you. Sorry, I'm going to come back to that path to profitability question. So Dhiresh made it very, very clear that the investments in tech and people, all that's coming through the IPO proceeds, right? So next 3 years, you're absolutely fine. You're saying your operating cash flow has been getting better. Give us a sense of how much. And will it be better enough to take care of the adjusted EBITDA losses over what, 2 years, 3 years? Just trying to make sense of how this improving operating cash flow will plow back into profitability. Even a rough range in terms of how you're expecting it to grow, that would help.
Yes, I think before I even come to the calculation around cash flow, today we have two streams of revenue. One is around logistics and the second is around advertising. And by the way, both of these metrics, if you look at global e-commerce companies, tend to go non-linearly as the platform gets larger and larger. So the opportunity there is still quite large as we continue to expand our own logistics platform, keep growing our volumes. We have a large opportunity to kind of make more revenue there. Advertising, we see our sellers, as we have more sellers on a platform, there is more competition and willingness for sellers to kind of use our ad products to get more visibility on the platform gets higher and higher. So both of these revenue streams will kind of see like exponential growth over the next coming years. Again, we cannot share projections. Now, even after this, we are adding new revenue streams to our business. So for example, we have an option of making money in a content commerce platform. Today, we are very, very focused on growth, so not capturing any take rate there. But our sellers basically take advantage of the influencer network and grow their business. There is an opportunity to make money there. We are recently starting our own financial services platform. That is a large opportunity. If you see some of the largest value commerce platforms in China, Southeast Asia, Latin America,
Right.
now they make a lot of like bottom line from financial services. So I think we're also investing in new revenue streams. So again, just in terms of growing revenue, there's a lot of potential there, and all of that should flow into bottom line because all of these are very high margin revenue streams. And I think in terms of cash flow, as you see, like for the last 2 years, we've been improving consistently our bottom line around EBITDA, but we have been positive on free cash flow. So I think that will continue to be even going forward. I don't expect that to kind of change.
Got it. More questions when you list, but you've got a large captive user base and you can sort of provide a lot many more things in terms of those revenue streams you spoke about. Good luck to you guys and the team at Meesho as you come to the markets. Vidit and Dhiresh, thanks for joining us here this morning on CNBC TV 18. Appreciate it.
Thank you.